From Pier 3 in San Francisco, welcome to Bloomberg West, where we cover the global technology and media companies that are reshaping our world. I'm Emily Chang. Our focus is on innovation, technology, and the future of business. Let's get straight to the rundown. Is Facebook considering unfriending the NASDAQ? Bloomberg has learned the social network has spoken with the New York Stock Exchange about moving its listing after an IPO plagued by technical difficulties. HP says it will slash 27,000 jobs, or 8% of its workforce, to save as much as $3.5 billion a year. Which units will be hit the hardest? We have all the details. And Google did not infringe Oracle's patents when it developed the Android operating system. That is the unanimous verdict handed down today in the Google versus Oracle trial. We will break it all down. But first, to the lead. Bloomberg has learned Facebook has had talks with the New York Stock Exchange about delisting from the NASDAQ after software glitches nearly botched its IPO. A source tells Bloomberg News the social network and the NYSE have been exchanging phone calls and emails, but the NYSE denies it, saying there have been no discussions with Facebook regarding switching their listing in light of the events last week, nor do we think a discussion along those lines would be appropriate at this time. Facebook stock recovered slightly today, gaining 3%, closing at $32 a share. It is down, though, now 16% over the last 3 days. And the lawsuits keep coming. A group of investors who lost $2.5 billion in the IPO have sued Morgan Stanley and the other underwriters, along with Facebook, Mark Zuckerberg himself, and CFO David Eversman, claiming they were misled. Morgan Stanley is considering reimbursing some investors for their losses. The SEC is reviewing the situation, but no action has been taken yet. Our editor-at-large, Corey Johnson, joins us now from the newsroom. He has experience with the IPO process. But, Corey, even you say you've never seen anything like this delisting thing.
Well, I mean, there have certainly been companies that have changed exchanges, but right after an IPO, there's never been anything like this Facebook IPO. It's one of the largest IPOs ever, yes, probably the largest retail IPO ever, and the problems they had opening the stock, or even just setting an opening time, was really weird, because opening a stock like this, or any big IPO, is a very difficult process. It involves a lot of counting and taking orders and getting all this stuff together. But yes, companies have switched. Quite often the switch is just the other way, from the New York Stock Exchange to the NASDAQ. In recent years, I've got a list of a couple of the companies we've seen switch from the New York Stock Exchange to NASDAQ. Texas Instruments just last fall, Wendy's, Viacom, companies, big companies, and companies of all stripes. At the end of the day, for the company, what they want is they want their stock to trade freely and fairly with a certain amount of liquidity so that they can get all the benefits of a stock that actually trades for a publicly traded company. But right after an IPO, a listing change like this, I don't think I've ever seen it.
Corey, what would this actually involve? I mean, how long would it take? How complicated would this be?
Well, in theory, it shouldn't take any, much time at all on the front end, at least for what traders, those people investing in the stock, might see. It would happen overnight or over a weekend or something. On the back end, of course, technologically, it's quite difficult. Interestingly, with the change in the ticker rules, the two-letter ticker, the traders in the stock might not notice a difference. Now, the difference is in the New York Stock Exchange system, as we'll discuss in some more depth with the next guest, at the end of the day, can boil down to a single person, a specialist, a person that stands at a counter. They wish they could sit. They stand all day. They stand at a counter and wait for the orders to come in. They watch an order book, whether it's electronic or sometimes in person, matching buyers with sellers, and a person is there to answer to that. The singular person is there to answer to that trade at the end of the day and resolve all those disputes. The NASDAQ has a disparate system that works differently, and that, of course, didn't work at all in the morning of the Facebook IPO.
All right, Corey, certainly an unexpected development in this story today. Thanks. Now, to better understand the whole sequence of events and the fallout from Facebook's IPO, let's check in with our senior West Coast correspondent, John Ehrlichman. The events keep happening.
I mean, it's incredible, and you highlighted some of those shareholder lawsuits. I mean, I think what shareholders clearly know is that Facebook stock has tumbled since the IPO, but there's been so much information flying, it's easy to get confused. Even we get confused with all the data that's there. The key date to go back to is May 9th. That was the day when Facebook updated its IPO documents to highlight a big trend in its business, that a lot of people are using Facebook on their phone, that affects their advertising business in the short term. What we can tell you The second step in that is that there are analysts at these banks that were underwriting the deal. The one getting most of the attention is Morgan Stanley, but JP Morgan and Goldman Sachs are also part of this story. These analysts updated their expectations for Facebook's performance based on that S1 document. What Bloomberg has learned is that in the case of Morgan Stanley, for example, they changed their predictions for profit to be about 6% lower for 2012. And from there, those analysts were in touch with the sales force that was basically handling the Facebook IPO, and those salespeople got in touch with certain investors who were considering participating in the IPO.
Mostly institutional investors.
Yes, and as we reported yesterday, we spoke to one of those investors who on that day got calls from all three firms saying, just wanted to let you know that that our analyst has trimmed their estimates on Facebook.
Now, as I understand it, nothing illegal necessarily happened here, that it's typical for institutional investors to get more information than individual or retail investors.
Yeah.
Right? I mean, and this issue of selective disclosure basically comes down to who knew what when.
It really does. And Corey said, look, this is an unusual situation. I mean, you wouldn't see shareholder lawsuits if there were those out there that felt that clearly the bankers and Facebook were in the wrong here, and there are arguments for that. What we did highlight last night was the fact that this, at the time, was a private company that was speaking to potential investors about investing in their company. And many will say, in the roadshow process, information is shared. Selectively, what does that mean? There were roadshow meetings that were closed off to the general public, only certain investors allowed in, and it really is determined based on how much information got out there.
And yet that is part of the standard process. Okay, John Ehrlichman, Senior West Coast Correspondent, thanks so much. Now, as we mentioned at the top of the show, a source has told Bloomberg News the New York Stock Exchange has been in communication with Facebook about moving its listing, but will the social network unfriend the NASDAQ so quickly? For more on this, let's bring in Kenny Polcari, Managing Director of ICAP Equities. He joins me now from our New York studio. So, Kenny, first of all, I just got to get your reaction to this. Of course, very unusual. What do you think?
Extremely unusual, and you know, not that I have any knowledge of this, and I'm not even sure, like you said, the exchange has come out and completely denied it. I think what it really says, though, it shows us a very high level of frustration, and it really is also a comment on the market structure, NASDAQ versus the New York Stock Exchange. That this rumor would even, if it's a rumor, whether it's true or not, the fact that it even got started really is a statement on market structure and the differences between what goes on at the New York Stock Exchange and what goes on in an automated marketplace like NASDAQ.
And Bloomberg News is reporting it along with other news outlets. I should point out, what would be the point at this point, Kenny, of actually moving exchanges? I mean, do they think they'd get a better price on the NYSE? Hasn't it settled at this point? It's
really not. It's not necessarily about getting a better price. It's really about market structure because, you know, listen, this whole thing started on Friday when there was a complete breakdown in technology at NASDAQ. It took longer to get the stock open. It took longer to indicate it. And then once it did, there was massive problems in terms of getting reports back, and people went for hours not knowing. That was a communication breakdown, a technology breakdown. So it's not necessarily a matter of better price or faster price. The New York Stock Exchange has as much, if not more, technology than any one of the marketplaces out there. The difference is we complement the technology with the human being at the point of sale. And like John or Corey made the comment, the person who's at that point of sale is a designated market maker, no longer the specialist the way that they used to be. The rule set has changed, and the rule set's changed over the last 5 or 6 years. His role today is to sit there and maintain the order book and maintain there are no problems. In the event that there is, he is responsible. There is somebody there that stands there at the point of sale. That is ultimately responsible for the trading in that stock. And that's the key difference, is that we continue to have the human interface with the technology.
Now, as John mentioned earlier, Facebook did update its S1 filing, did put it out there that more users were shifting to mobile, did put it out there that advertising wasn't growing as fast as users were growing. Are investors right to feel wronged by this, or was the information really out there for them to see?
Listen, I think I can see the story both ways. I think there are some investors that might feel upset with this if, in fact, there was selective disclosure and they didn't get it. But I have to tell you something. In the end, the investment banks go around the country. They sell this story to anyone that wants to invest. The ultimate asset manager, and let's talk institutional first, the ultimate asset manager is going to do his own work. He's going to analyze the S1. He's going to analyze the story. He's going to either believe the story or not believe the story. No one holds a gun to anyone's head and says, you have to buy this stock. This is the price you have to buy it. Every asset manager makes their own decision. What I will say, and we all know it because we've been talking about it for months, there was this hype, there was this overhype that was created about Facebook. People were nuts. I mean, we know the stories about people thought that if you didn't get in on day one, you were never going to get in, that, you know, it was instant millions and it was going to trade and I was never going to get a shot. Listen, they brought 500 million shares to the market. Where did anybody think this stock was really going? 500 million shares. Think about all that stock. And so in that sense, it's difficult for me to think that anybody could be really upset because, like I said, no one held a gun to anyone's head and said you had to buy it or you didn't have to buy it. Everyone did their own research, and the fact that the stock opened, it was priced at 38. It was priced at 38. Don't forget, there was the talk about how there was so much demand, there was so many people knocking on the door that they had to bring out more stock. They had to raise the price. In fact, I think what the market has told us is that this stock went right back to $31, which was well within the original range of 24, 35, or 25, 35. And so the truth is, what were the investment bankers thinking? Was it just a lot of hype because everyone was greedy, or was there in fact a breakdown in communication? And I think that's going to be key, and that's what you're going to find out.
What exactly did go wrong along the way to misestimate demand so drastically? All right, Kenny Polcari, Managing Director of ICAP Equities, thanks so much for joining us today from New York.
Thanks.
Now, as we mentioned, Facebook is already facing shareholder lawsuits related to the IPO and the information provided to potential investors before the start of trading. We will talk to one of the attorneys suing the social network about just was and was not legal coming up. And also the latest tech news. Don't forget to check out our tech channel, Bloomberg.com/technology. Welcome back. I'm Emily Chang. Hewlett-Packard has just announced it's slashing 27,000 jobs, about 8% of its workforce. Bloomberg had reported the layoffs were in the works last week, but the official announcement came today as HP reported earnings after the bell. The computer maker reporting sales down 3% to around $30 billion. Profits slid a whopping 31% to $1.5 billion. For a drill down on this stock on the move, let's check in with our editor-at-large, Corey Johnson. Corey?
Yeah, you know, the market seems to like these results, although over the course of the last year, if you look at the stock chart for 1 year, the Hewlett-Packard has not performed well at all. It's one of the worst. It's the worst performing stock in the Dow, and down 40% in the course of the last year. I mean, this is about this time last year we were searching for where is Leo Apotheker. Well, Leo is gone. Meg Whitman's there, but she hasn't been able to stop the sales decline. Take a look at this, the revenue decline on the year-over-year basis. And so while the market likes the results today and the stock's trading up, these results aren't good. They're just better than what was expected. You can see the year-over-year revenue decline. We're now 3 quarters in a row where revenue's shrinking. And in particular, I want to zoom in here a little bit on the actual revenue for the printer division, because I think the imaging and printing division has long been one of the most important divisions at Hewlett-Packard. Although it's not the most profitable division right now, it has been in the past, and there have been some big changes here. Look at the vanishing revenues for this business. This is their imaging and printing business. It's not selling printers, it's selling printer cartridges and paper. And so you see 4 consecutive quarters of decline on a revenue basis with big numbers. Worse still, the margins are not what they were. This is the business that used to do 20% margins. The margins have been coming down. Now, the results out today show a slight improvement in the operating margins for the print business. So, you know, from 12.2%, I said in English, up to 13.2%, but that's well off what they had been. And suffering perhaps from some competition from Kodak, among others, interestingly. The Kodak printers, according to those who review printers, use less ink. Maybe more attractive to users. The bottom line is Hewlett-Packard has a lot of problems to fix, and maybe the crown jewel of it all, the printing division, might be one of those problems. It's showing a little bit of improvement in operating margins, but the business is still shrinking. Emily?
One of the many problems Meg Whitman is trying to solve. All right, thanks for that. Corey, now joining us with more on these layoffs and the company's future is Bloomberg News technology writer Jordan Robertson, who's just one of the 65 reporters and editors covering tech here in the San Francisco Bureau. So, Jordan, what can you tell us about these layoffs so far? What divisions are they going to come from?
The most important thing to think about these layoffs is that the majority of them, as Bloomberg reported last week, are going to come from the Technology Services Division. Now, most people know HP as being the world's biggest PC maker, biggest printer maker, one of the biggest printer ink makers. What they may not know is that HP is also one of the biggest technology services providers. Unfortunately for HP, they're on the wrong side of the trends in all three divisions. In PCs, they're facing pressure from iPads and smartphones. Printer ink, they're facing pressure from generic ink refillers. And in services, they're facing pressure from a move to automation and cloud computing, which IBM is a specialist in and is doing very well in. HP is not. Right, competition from Big Blue. The market's definitely liking this information, though for some reason the stock up 10% in after hours. Is this a necessary evil for HP to have to go through? Yeah, as unfortunate as the large number of layoffs is, EDS, which is the services company that HP bought back in 2008 that got them into the services business, has long been seen as a very large company within HP. EDS had about 140,000 employees when HP bought it. And immediately after the acquisition, HP announced about 25,000 job cuts. And the majority of those cuts were targeted at EDS. It's long been thought that there would be more cuts in the offing. And unfortunately today, what we're seeing is kind of that second phase there. So it's a lot of people, but investors seem to like it. There were a lot of employees in that division. How do investors feel about Meg Whitman? How confident are they? I mean, we know she's a great communicator, but is she going to be a good operator? Can she turn this company around? The sense we get from talking to analysts and investors is that they're cautiously optimistic about Meg's chances. Having said that, though, the stock is down about 8% since she took over in September. So within 9 months, she's done a few major things, this being one of the most key moves. The market is cautiously optimistic. However, there is some uncertainty about whether she can kind of right the ship. Well, exactly. Sales down 31% over the last year, so she hasn't been able to stop that yet. Of course, we'll see what she brings forward in the quarters to come. But Jordan Robertson, Bloomberg News, thanks so much. Thanks for that input. A jury ruled unanimously in Google's favor, finding the search giant did not infringe any of Oracle's patents when creating the Android operating system. That story is next. This is Bloomberg West. I'm Emily Chang. Google scored a victory today in federal court when a jury ruled unanimously that it did not infringe any of Oracle's patents when building Android. Our editor-at-large, Corey, has been following the case from the start, and he's got more from the newsroom. Corey, and it was unanimous.
Yes, thus far. It ain't over yet, but Oracle claimed in this suit that Google stole 2 patents. They claimed that more before that, but eventually it was about 2 patents in the Java programming language were used to develop Android. Of course, Android's now on 300 million phones plus, more of them cranking out every day. But the 10-man jury ruled that unanimously that neither of the 2 patents at issue were infringed. So where do they go from here? Joining us now to discuss is patent expert Kevin Rivette. I can't talk today. 3LP Partners. I was surprised by this because of that one email from a Google programmer who was asked by the CEOs of Google, the founding CEOs at least, fix this problem without using Java, and he said, we can't, we got to buy a license. That seemed like a smoking gun.
It seems like it, but actually it's not.
Why?
Because at the end of the day, lots of extraneous kind of comments like that show up all over the place in emails. They used to show up on the patents. Gee, we got a problem with this one. And in fact, when you get to the legal department, there wasn't a problem. So this is just an engineer making a statement. And
there were huge fights about that email, iterations of the email where the lawyers started to say that was sent by accident.
Right.
Then a later iteration of the email was they CC'd the lawyers and they said it was privileged because... So Google seemed to recognize that this email was a big problem too.
Well, many times the jury can't figure that out, so what you want to do is keep it out of their hands. So I think what was really going on is they're saying, gee, it shouldn't have been written, we could have gotten around it, or we didn't need it, which is kind of what the court was saying. And they were just moaning and groaning to try
now,
to get around it.
Without getting too technical about what the patents were and how they worked,
right?
Because I understand them, and it is very technical. But the legal case depended on two things, right?
Well, they depended on, first you've got to have validity. And so
the patents have to be valid patents to stand up.
Right. And so Google actually put those patents into what they call re-exam at the patent office.
Right.
And they're not done yet.
So the patent office could very well come out and say these patents never should have been issued, aren't valid.
Right. Or they could come back and say these are very, very good patents and they're very valid. The second part is whether or not they're infringed. And I wasn't there during the trial, but I guess that's the part where they really couldn't find any infringement.
Then there was also the copyright issue, which
yes.
was really weird because Google or
I'm glad
Oracle,
you're saying that because I agree with you.
Well, Oracle was saying the instructions, quite literally the instructions on how to use this invention are a separate thing that is copyrighted and you're not allowed to use the instructions, let alone infringe on the patents themselves.
Well, my understanding is the copyright was on the APIs.
On the APIs, sorry, not the patents.
Right. So the APIs are the actual functional way you get into the program.
Right.
Well, in copyright, you can't actually copyright something that's functional. It has to be an expression. So that's what part of the fight was about. Can you really copyright that? And the court never got there, and they just said it was too small an amount, and therefore, there wasn't really a big infringement. And
so the judge still has one important thing to decide here.
He has one important thing to decide, but it is important to all copyright. So this is not a small decision he's going to make. Can you copyright APIs? If you can't, that opens up a whole world of opportunity for people.
Well, I've always worried that lawyers don't have enough work. So for your
there
sake,
you go.
I hope that...
well, I'm not a practicing one. I've reformed.
In that case, if you lay all the lawyers on earth end to end...
I won't be one of them.
No, there we go. Kevin Rivette, 3LP Partners, thanks for your time. Emily?
Thanks, Corey. We do have some breaking news quickly out of Research in Motion. The head of global sales for RIM, Patrick Spence, has resigned after a long 14 years at the company. We know a lot of management changes going on at Research in Motion since new CEO Thorsten Heinz took over. The sales team will now report to the new operating chief, Christian Terr. Now, it has been almost a year since Pandora went public, and at the time there were doubts about its profitability. But the internet radio company reported earnings today that might be encouraging some analysts to change their tune, and that is just ahead. You are watching Bloomberg West, where we focus on technology and the future of business. I'm Emily Chang with your Bloomberg top headlines. NetApp shares are plunging more than 20% after hours after the data storage maker lowered its current quarter forecast. The company has been struggling as the U.S. military and intelligence agencies cut spending on data storage. European sales have also taken a big hit, in part due to the ongoing debt crisis. Shares of Dell fell the most in nearly 12 years today. The stock was down 17% after the computer maker lowered its second quarter outlook. Dell is reorganizing its sales force to focus on selling packages of hardware and software. The company also hoping PC sales get a boost once Microsoft releases its Windows 8 software. And getting a great deal on those Samsung or Sony TVs may be a thing of the past. Both companies are trying to force U.S. retailers to maintain a minimum price on their televisions. This comes after TV shipments fell last year for the first time since 2004, leading to a drop in prices and huge losses for TV manufacturers. Pandora pleased investors with its latest results. While the company is still losing money, its sales topped estimates, as did its outlook. For more on Pandora's crowd-pleasing quarter, let's check in with our senior West Coast correspondent, John.
I mean, it really is a sales story. We talk about Amazon as the story of sales. People aren't necessarily looking at how much money they're making because their margins are so razor thin. In the case of Pandora, we knew this was going to be an unprofitable quarter. The question was, is the user base growing fast enough that the advertising they're generating is going to be crowd-pleasing for Wall Street. And the outlook is just as important. I mean, if you look now at the revenue that they generated for the last few years and now their estimates for what they're going to generate in this fiscal year, there you can see they're now looking for $427 million. I mean, this tells you the story of a fast-growing company, 150% growth 3 years ago, then 100% growth 2 years ago, and it's tough to keep growing at those same rates, but still on pace for 55% revenue growth. And the end of the day story is, as they get more advertisers on board with the Pandora story, that helps to cover those pricey royalties that they have to pay for all the songs that get streamed, and they certainly are working on that to a great degree.
What about the S word, Spotify, and the competition there?
I mean, there's no doubt there is competition there, and yet you look at this quarter and you see the user base growing, and you have to wonder if the real battle is between Pandora and Spotify, or if it's between Pandora and the traditional radio players, or iHeartRadio, which is another name we've talked a lot about, because they're going directly for that local advertising market as well. I would also say, to a certain extent, Pandora is battling itself in the sense that the costs to maintain this business have made it somewhat challenging to please Wall Street every quarter so far, and they're still trying to prove that to a certain extent.
Now, Pandora's actually way up in after hours, so we'll have to see where it opens tomorrow, but the stock is down more than 35% since last year when it started trading, and it's gotten lumped into the Facebook bunch now, also being down.
Sure. I mean, you're absolutely right. And this is a company that went public at $16 a share. And this is the challenge of being public and yet still figuring out the business model. I mean, the story we told on Pandora last quarter was that the financials were not that strong compared to what Wall Street is looking for. A quarter makes a difference, but as you pointed out, the IPO price, $16, not trading at that level right now.
We'll be watching to see where Pandora opens in the morning. Thanks for that, John. As lawsuits pile up against Facebook, the underwriters, and the NASDAQ, investors want answers and their money back. Facebook shares recovered slightly today, but are still down 16% since opening day. Our editor-at-large, Corey, has more from the newsroom. Corey?
Yeah, Emily, one of those lawsuits filed by Rob Pronge. He's filed a complaint against Facebook in California's San Mateo County yesterday, right near here, and he's an attorney at Glancy, Binkow, and Goldberg, joining us now from Los Angeles. Rob, what did Facebook do wrong? It seems like what Facebook did is what every company does before they go public.
Well, the core allegations in our complaint are that the offering materials provided to investors and the general investing public contained material omissions and or material misstatements. And, I think you've seen a lot of news reports about this recently. I think you've been talking about this earlier. And that is these analyst revisions and these reduced growth forecasts that were being provided only to select high-end customers of the investment banks. That information then should have been passed on in the registration statement and prospectus to the investing public at whole.
Well, all right, so, I mean, name one misstatement that they made. Because I've read the documents. I don't know if everything could be fake, but I think most of it's not. Name one misstatement in there.
Well, we think it's the omission of the reduced forecasts and especially given the size and nature of the forecast, but also, knowing what we know now, there's some statements in the offering materials, purported risk warnings, that really reflect something about, discuss trends, but really the extent of the revenue growth reductions was far greater, and we think that those statements were misleading themselves.
I mean, at the end of the day, these were analysts projecting what might happen, how they disseminated it or what they disseminated. I mean, the companies changed their filing during the process and said, the trends that we've seen continue. We don't know what the results are. Facebook doesn't even know what the results are going to be yet.
The troubling aspect of this are the reports that those analyst the reduced forecasts actually came at the instruction of the company itself. I mean, the company.
Yeah.
That's the real, I guess, problematic area for them.
So your real concern is direct communication about projections from Facebook to the analysts. You say if that happened, that's a violation. Well, they shouldn't be given the numbers out in advance.
The securities laws are designed to ensure that investors in public offerings are provided all the information that they need to make an informed decision on whether or not they want to purchase the securities. And we think that, in our view, that information should have been included. And the omission and selective disclosure of that was a violation of certain provisions of the federal securities laws.
I hope you get to Discovery, because I can't wait to find out what you're going to find. Rob Prongate, attorney at Glancy, Binkow and Goldberg from Los Angeles. Thank you. Emily?
Thanks, Corey. As the number of people watching TV shows and movies on mobile devices keeps on growing, how are advertisers adjusting to those target audiences? Find out next in today's New Hollywood. Welcome back. I'm Emily Chang. Facebook Chief Operating Officer Sheryl Sandberg did not talk about the controversial issues involving Facebook's IPO when she spoke at Harvard Business School today, but she did talk quite a bit about her career and working with Mark Zuckerberg.
I've cried at work. I've told people I've cried at work, and this got reported in the press as Sheryl Sandberg cried on Mark Zuckerberg's shoulder, which is not exactly what happened. I talk about my hopes and fears, and I ask people about theirs. I try to be myself, honest about my strengths and weaknesses, and I encourage others to do the same.
Sandberg also told students to make sure they keep in touch via Facebook and to click on some ads as well. The big TV networks have always fought for their fair share of advertising budgets. These days, the challenge is convincing advertisers that people watching shows online and on mobile devices is a good thing for TV. Our senior West Coast correspondent, John Ehrlichman, back with this week's New Hollywood. John?
Thanks, Emily. Each year, networks host the upfronts where they unveil their big show plans for advertisers. But the advertisers don't just care about the shows these days. They want to know where people are going to be watching those shows. And you would expect the folks at Nielsen, the go-to company for ratings, to be on top of this trend. Steve Hasker is the firm's president of media products and advertiser solutions. He's in New York. And Steve, you were closely monitoring the upfronts this year. From this topic perspective, what was your biggest takeaway?
Yeah, John, we have been watching the upfronts very, very carefully, and all of the networks have for the last 4 or 5 years been talking about their cross-platform offers. So in other words, putting their programming on television as they always have, but also putting them on different devices, principally the PC, but increasingly tablets and smartphones. And as the player who's measured the audiences on TV for many, many years, they've turned to us for that. Increasingly, they're turning to us across the platforms. So our online campaign ratings product is in this upfront being used to measure the online viewing of TV shows and added to the viewing on traditional television.
And to a certain extent, they were competing against some of the technology companies that are pushing their own content on their own platforms through some new fronts, as they're called now, upfronts versus the new fronts. But when it comes to an advertiser, a brand that wants to push out a new product, what's the breakdown? How much of that money is going to CBS or NBC or ABC, and how much is going other places, other digital spots?
Yeah, TV has been the lead horse for many years, as we all know, and from the perspective of digital, the real growth in digital has been in search and in direct response advertising. Direct response being the kind of stuff that you click on. You click through and you get more information, or you get to buy a product. The branded component online has been relatively small. We're starting to see real growth there. So if you think about the TV proportion, we're talking about 10% of that spend or thereabouts in the online branded part, but growing at a nice clip.
And as for why TV is able to hold on to so much of that money, let's talk about sports programming, because that still is a key for so many people. If I'm going to pay for cable, it's because I can watch ESPN or sports programming, etc. Yeah,
John, sports is a great example, because if you think about where the rights are to the live broadcasts, they are still with the major broadcast and cable networks. In other words, if you want to see the game live, you've got to have a TV, you've got to be watching it on TV. And we're seeing that persist certainly through this year. It'll be interesting to see if and when that changes over time. Having said that, what avid sports fans are doing, much more than they ever have before, is accessing highlights some of the clips and the reels and the scores in real time and throughout the day and night on tablets, on PCs and on mobile devices. So sports is really leading the way in terms of being able to offer the consumer a multi-platform experience and offer the rights owners the chance to monetize their content on multiple platforms.
Steve, before we started this segment, we had a soundbite from Sheryl Sandberg of Facebook. How much did the Facebook factor, or the Twitter factor for that much, factor in the conversations at the upfronts this year? Obviously, social media buzz is key to TV shows surviving these days.
Yeah, what our research at Nielsen is showing is that more and more Americans, when they're watching live TV, also have a PC or a tablet or a smartphone on and switched on and using it in front of them, and very often they're using social media. So they're tweeting about the program, or they're putting entries on Facebook about the program or the ad that they're watching, and that's a very interesting proposition, not only for Twitter and Facebook as they think about being part of that TV advertising buy. It's also an interesting opportunity for the TV networks themselves to think about how they interact and how they play in that social space with Facebook, with Twitter and some of the other emerging social media platforms.
So then are you getting the sense that if there's a TV show, it's a new show, it's not a #1 or a #2, that it can potentially survive for a while, even if its TV ratings aren't that strong, if it's doing well on other platforms and the social media buzz is there? In other words, is that the way you measure now, almost like a 1, 2, 3?
Yeah, increasingly we're looking not only at the number of eyeballs watching a program, but also the degree of engagement in that program or in the advertising around that programming, and also in the behavior of the consumers on and offline as a result of seeing that program. So in other words, A, did you see the program or the ad? Secondly, did it change your mind about the characters, about the products being marketed? And then lastly, did you go and do something as a result of that exposure? Did you go and buy the product, or did you talk about the product or talk about the show in a social media environment? We're increasingly measuring all of those because that's where the advertisers want us to go.
All right, interesting stuff. Hey, Steve, thanks for your time.
Thanks, John. Good to be here.
Steve Hasker of Nielsen. And Emily, I'll send it back to you.
Thanks so much, John. One of the biggest concerns for Facebook investors, how will the company make money off its mobile app? We dig into the mobile ad wars and tell you what Facebook can do better. Coming up. Welcome back to Bloomberg West. I'm Emily Chang. A partner at venture capital firm Kleiner Perkins Caulfield Byers is suing the firm for discrimination and retaliation. Ellen Powell filed suit in San Francisco Superior Court. She claims she was sexually harassed for years by former partner Ajit Nazra and then denied career opportunities when she refused his advances. She also says she was discriminated against because of her gender. Kleiner Perkins says the lawsuit is without merit. In a statement, a spokeswoman said the firm has been a diversity pioneer in its industry and was one of the first venture capital firms to hire women as partners. The number of women partners at the firm is one of the highest within the venture capital arena, and the firm has actively supported women in all respects. Powell has been with Kleiner Perkins for 7 years. Now, one of the biggest concerns about Facebook's business model is its lack of mobile ads, despite user traffic shifting to mobile devices. Meantime, the mobile advertising market is exploding. The Kelsey Group projects mobile ad spending will reach $2.7 billion by the end of this year, $7.7 billion by 2016. An online ad technology company, the Rubicon Project, has beefed up its mobile efforts by announcing its purchase of the ad platform Mobsmith today. And with me now to discuss that and Facebook's future in mobile is the Rubicon Project CEO, Frank Adante. Frank, welcome to Bloomberg West. Great to have you here.
Thank you for having me.
So quickly, just tell me about this acquisition. What does this add to Rubicon?
Sure. So we operate a real-time trading platform for digital advertising. So essentially what we're doing is we're bringing Wall Street technology to Madison Avenue to automate the buying and selling of online advertising. So mobile's certainly a big piece of it. As you mentioned, mobile's one of the fastest growing mediums of all time. And publishers, such as the top publishers on the internet, have to have a mobile strategy to monetize their inventory. And they also have to have technology to support it.
Speaking of trading technology, I have to ask you this question because you actually took a company public on the NASDAQ some years ago. But what's your take on Facebook having talks with the New York Stock Exchange about delisting from the NASDAQ after the technical glitches in its IPO?
Yeah, I don't know the specifics of what happened there, but I can tell you that trading technology is incredibly complicated. We've actually architected a lot of our technology off of NASDAQ-like technology in Wall Street, flash trading, very high demand type stuff. We process about 150 billion trades on a monthly basis, which is about double the volume of NASDAQ. And I can tell you that there's enormous amounts of complexity that just go into facilitating that those trades happen efficiently and effectively and also reliably. So I would...
You never had any problems with the NASDAQ?
We never did. We never did, but I could see how a high volume, high demand transaction like Facebook could potentially test the system.
Now, speaking of Facebook's mobile problem, essentially, in that they really don't monetize mobile traffic at all, how do they tackle this? What do they need to do? You were early to the mobile advertising game.
Yeah, I think it's probably even a larger issue for Facebook. Facebook hasn't invested in advertising technology to the depth that companies like Google or even Microsoft or Yahoo have. So they've got a lot of catch-up to do in just building out their advertising technology platforms, and mobile is certainly a very big piece of that as well.
Why is mobile so difficult for Facebook? I mean, what's the holdup?
Well, it's a new medium, even though it's going to be a $2.7 billion market this year, which is very substantial. Compared to digital advertising, which is about a $50 billion market, it's still in the very early stages. So a lot of companies are still learning, and I think Facebook is no different.
So it's taken them 8 years to get to the point where they are today. I mean, how long do you see it taking for them to get to a point where mobile ads are actually a viable part of the business?
Well, I think it already is a viable part of their traffic and their user base. So I think very quickly they've got to go figure out how they're going to monetize that. And by the way, that extends to all of the top publishers on the internet. Facebook is no different than them. They've all got to go figure out a mobile strategy and invest in the technology to go make that work.
So what's next for Rubicon?
Well, if you look at the market today, there's 3 major segments to it. There's certainly Google, and then you've got Facebook and the rest of the top 5. And then you've got this whole other segment of the market, which is called the ComScore 500. So the top 500 sites on the internet, companies like NBC, Time Inc., Washington Post. And they now need to compete with the likes of Google and Facebook in a very competitive market. And they need strategies in place to go do that, and they also need a technology platform to do that. So that's our place in the market, is to help them monetize their digital advertising in both display and mobile, and help them provide that real-time trading platform to make that efficient so they can compete.
But obviously a lot of companies out there do have a lot of work to do in mobile.
Sure, everyone does, yeah.
Okay, Frank Adante of the Rubicon Project, thanks so much for joining us today.
Thank you.
On Bloomberg West. Up next, stick around for our B West Bite, one number that reveals a whole lot. Tomorrow morning at 6 a.m. Eastern on Inside Track, more pressure on Facebook. Tomorrow is the first day you can short sell the stock. And with the retail investor feeling burned by the IPO process, Facebook's many users may not come to the rescue. Tune in for much more tomorrow morning on Inside Track, only on Bloomberg Television. And now it's time for the B West Bite, where we focus on one number that tells a whole lot. What do we have today?
0. I know, I did a bite. The bite is 0. 0 is how many balls Warren Buffett has swung at while they're still in the pitcher's glove. He has this great quote. I've swung. I think it's important in this IPO. The quote is, "I've never swung at a ball while it's still in a pitcher's glove."
Okay.
It's about investing and when you have to buy a deal. You don't have to buy a company the day it goes public. You don't have to.
So you're saying investors, they had the information that was in the S1.
We reported consistently that their business was slowing down, that there were issues, that the user growth was slowing down, that the revenue per user had turned negative. It was in there, but you don't have to rush out and do these deals. If Facebook's a great company on Friday when they do an IPO, it's a great company on Wednesday after they've done the IPO.
All I will say is I think one of the key things we've been learning here is that clearly there was an opportunity for Facebook to sell more stock, and they took advantage of that opportunity.
Yeah.
And in retrospect, maybe had they not taken that extra step, we wouldn't be talking about this the way things are right
exactly.
now. And everybody would have been happy.
Clearly, the size of the offering was misestimated. In retrospect, they shouldn't have raised the size of the offering.
They got more money because they raised the size of the offering. So
the insiders and the backers got more money, but it didn't have a pop like they were looking for. It didn't. In fact, it's down 16%.
Yeah.
They should all play baseball. I mean, Buffett, I think he can still toss.
I'm going to play right now.
Hey, are you really?
I am. I'm going on AT&T Park.
Well, I assume Mark Zuckerberg has a direct line to Warren Buffett if he wants some advice.
Yeah.
We shall see. Thanks, guys. Remember, you can get all the latest headlines at the top of the hour on Bloomberg Radio all the time on our new tech channel, Bloomberg.com/technology. We're back tomorrow.